everyone. I'm Andrew with Jesani Wealth Management. And margin of safety is one of the components, and I think really probably the most important component of the second dimension of our multi-asset allocation strategy. So, what makes an asset risky is the price that you pay for it. So, of course, if there's an asset available to invest in and you pay a price that's higher than its actual value, you're exposing yourself to greater risk than if you were to able to buy that same asset at a lower price than its actual value or its intrinsic value. And Warren Buffett actually said that price is what you pay and value is what you actually get. So margin of safety, loosely defined, is saying that we're not going to be able to predict accurately the future of an investment in every single occasion accurately. So we're allowing ourselves a margin of safety or a margin of error where we can be wrong and the profits or the growth of the company be less than what we anticipated as its actual intrinsic value, and we can still not be upside down in an investment, basically. So it's a theory that's really discussed extensively in Benjamin Graham's book, The Intelligent Investor, probably one of the most famous investment book that exists today. And also Seth Klarman, who's the CEO of Baupost Securities, a $30 billion value hedge fund, wrote an entire book just on this one principle, the margin of safety. But it's really a value concept that states when the market price is significantly below the intrinsic value of a stock, we then have margin of safety and we can make some errors in predicting the future and still have some success in that particular investment. In fact, Benjamin Graham in the Intelligent Investor book said that the function of margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. So we're talking about the intrinsic value of a business or a stock versus the actual price that it's trading at today. So really the first step in kind of differentiating a value investor from a stock trader or speculator is a value investor is looking at the fundamentals of the company and believes that based on these fundamentals or the cash flows or the expected profits of the underlying business, that the value of the business is a certain amount, the intrinsic value, and then you can either buy it at, below, or above, but at least you have a baseline of intrinsic value. So you're looking at the fundamentals of the company and typically long term, where as a speculator, and it's very, very difficult, especially in the equity markets, not to be a speculator, but a speculator is making judgment not on the fundamentals, but a prediction on the behavior of other people. So they're really only looking at the price, not really looking at the underlying business. And speculators tend to go with the crowd. And again, particularly in the equity markets, it can be a real challenge to avoid being a speculator and focus on actual intrinsic value of companies and then buying at a price below that to give you some margin of safety or lower risk, higher probability for returns. So when we're talking about margin of safety, again, buying at a price that's lower than the intrinsic value. So of course, the first step is figuring out what is the actual intrinsic value of an investment or an asset or a stock. So first thing you do is called a discounted cash flow analysis, which is number one, you're taking how much money is the business expected to generate each year, and you typically go out 10 years. Secondly is how fast is the company growing and how fast is it expected to grow over the next 10 years. And then you use these two growth factors to predict or project what it's going to look like 10 years down the road. And then you want to add in a one-time, usually a pretty significant cash flow for the potential sale of that business 10 years down the road. And then you take those four and you discount it by your expected rate of return, annual rate of return that you expect to get from that investor. That's going to give you your overall intrinsic value of the business. then of course the only thing left to do is simply divide that intrinsic value by the number of shares outstanding, which is going to give you a stock price at the intrinsic value. Now, most value investors like Benjamin Graham or Warren Buffett like to find opportunities where you have a 50% margin of safety. So that means if the intrinsic value of a stock is 100, you want to buy it at $50 or less. Now, certainly in the past couple of years in these markets and the valuations that we're seeing, it's much harder to find those opportunities. But even if you can pick investments where you have 30, 40, even 20% margin of safety, you're really dramatically increasing your probability for a better return in the long term, and you're decreasing your risk. So remember, risk is the difference between intrinsic value and the actual price. That's your risk. So when you're calculating intrinsic value, it's important to make sure that you're using historically reliable metrics and making reasonable long-term assumptions. So overall, margin of safety gives you natural leverage in an investment. It reduces your risk and it gives you a higher return potential. So it's certainly something that can be used in every asset class. We use it in every asset class in our multidimensional allocation strategy. If you'd ever like me to walk through how to calculate the intrinsic value of a particular business, certainly reach out to me. My name is Andrew Constantinidis at Jesani Wealth Management. Thanks, everyone. Take care.